Hello, this is Victor Cuevas with Victor for Advice. Today I'm going to shoot a video on borrowing from the infinite banking policy, the banking feature. And this is one of the main reasons why we want to take out an infinite banking policy to begin with. I get a lot of questions about that, mainly to clarify how it all works and the interest and how it's paid back and all these kinds of things. And so I thought I'd shoot this quick video and clarify some of those things and answer those questions before we even talk in that case. So here we go. Now, there's two ways you can borrow from your own assets. That's what basically infinite banking is, borrowing from your assets. You can use a whole life insurance policy, or you can use a traditional bank. You can use a brokerage account too, but I'm just going to use the main ones: whole life policy, traditional bank. Now remember, this is very important, that when using the whole life insurance policy, it must be a policy taken out with a mutual life insurance company. A mutual life insurance company. That means that the policy owners are the owners of the insurance company. Okay, and it must have a paid up additions rider on it, and it must be designed to minimize the death benefit, which minimizes the cost of the insurance, and it maximizes the cash accumulation through paid up additions. That's very important. It's not your traditional whole life that you get with the insurance agent down the street who doesn't have a clue what infinite banking is. So that's important to note. And then the traditional bank is any bank, on the street, the bank that you have your checking account with. Now, in each case, you're going to have money in those instruments. So you're going to have cash value in your insurance policy, and you're going to have money at the bank. Now, in your insurance policy, this is cash that you have accumulated over a period of time, or when you opened the policy and had it issued, you just dumped some cash in there, and then you're going to continue to contribute to it over the years. But you've got an initial cash dump into it, $10,000, $20,000, $30,000, $50,000, whatever amount of money you put in there, and that serves as your bank. So you, in both cases. Now, in the traditional bank, you may have it in a savings account in order to use it to borrow against. You're going to end up putting it into a certificate of deposit for a certain period of time, and then the bank would allow you to borrow from it. So I have two categories here: whole life, traditional bank. I'm going to kind of go over some of the bullet points here that kind of gives you the differences between the two. Now, with whole life policy, when you take out a loan, you pay interest to the insurance company, right? And then over here with the traditional bank, you pay interest to the bank, right? Oops. And I just put to bank. Now, when you take out a loan from the whole life policy, the insurance company will lend you the money from their general account. So let's suppose you have $20,000 in cash value in your life insurance policy. You want to borrow $10,000. The insurance company is going to lend you $10,000 from their general account, and they're not going to take the money out of your policy. I mean, that's not what we're doing. They're lending the money, their own money, but using the cash value in your life insurance policy as the collateral. Okay, when you pay the interest, and it's 5% usually, you pay that interest back to the insurance company. With the bank, you're going to take your money and you're going to put it into a certificate of deposit, and now it's held there, And let's suppose you have $20,000 in savings and you took $10,000 and put it in a CD. Then the bank will lend you the $10,000 at whatever percentage rate, is usually very low. And you pay it back, and that's a good loan for them because they've got collateral, $10,000. They know they're going to get their money. So in those cases, they're somewhat similar. Now, when you're paying back that interest, there's a difference there. Because when you pay back the interest to the insurance company, that's profit for them, and you share in profit. Okay, with the bank. Bank keeps all profit. Now, since you are a part owner of the insurance company, because it's a mutual company and you own a policy, part of the profit that insurance company makes are loans to you and everybody else. They make loans to, for instance, you might have a furniture store like Ashley Furniture, and they loan money, let you borrow money to buy furniture, right? Well, they don't have the money to give you. They go buy that money someplace, and they turn around and lend it to you and pay back that loan with the money you give them, plus they charge you extra. So they might buy, let's suppose they buy a block of money from an insurance company, at 7%, and they loan it to you at 11%. Are you going to pay them back 11%? They're going to pay back the insurance company 7%. They make a profit, the spread, and the insurance company makes a profit. See how that goes? So, how do you share in the profits? Well, from owning that policy, well, you get dividend payments every year. And the dividend payments are a result of the total profit of the company. So there's a big difference there. Also, let's go over here. I can put my glasses on, I can see better. All right. With the whole life policy, there's going to be liquidity. I could say here, access to money. Let's put it this, access to your cash value. Okay? The bank, no liquidity. In other words, with the bank, when you put that money in a CD for 2 years, you're telling the bank that, hey, I'm going to pay this money back in 2 years, because at the end of 2 years, that CD comes due. And let's suppose you decide to pay the loan off early. Well, you've got a 2-year CD, and if you take it out before that 2 years, there's going to be an interest penalty on it. So it's not as flexible. Whereas with the insurance company, if you borrow $10,000 and a year later, you've paid down $2,000 and you started out with, $20,000 cash value, guess what? That $2,000 goes back available to you. So you're back to $12,000 you can borrow, and if you pay that note down to $5,000, now there's $15,000 more left that you can borrow from against. See how that goes? Doesn't work that way with the bank. So there's much, much more flexibility when borrowing from your life insurance policy. Okay, you get better interest on your cash value your collateral. Now, when you borrow from an insurance company, your cash value continues to grow unhindered. This is important. So if you're cranking out 4.5%, 5%, 5.5% over here in your cash value, it's still going to continue to earn interest and dividends. You're just going to pay back the interest to the insurance company for borrowing the money. However, with the bank, you have, let's say you say very low interest, right? Very low interest. Your CD may give you, I don't know, depending if you shop around, might give you 1.5% for 2 years, 2% for 2 years, maybe less. Who knows? It's not going to be much. That's another advantage over regular bank doing it. Another advantage is that you have tax-free legacy. In other words, if you have a funded whole life infinite banking type policy, that policy, when you design it and you put money into, let's say suppose it has $20,000 in cash value, it might have a death benefit of $400,000 or $500,000 or $250,000, depending on your age. But it's going to be many, many, many times more money in tax-free death benefit than the cash value in the policy. Whereas when you come over here to traditional bank, right, there is no legacy value. In other words, if you've got, $10,000 in a CD at the bank and you borrow against it the $10,000, you've paid $2,000 back, and now you die prematurely, well, the bank is going to get that $8,000 because you owe it to them, and it's in there as collateral, and you have $12,000 left in the bank if you had $20,000, and that's what your family gets, the $12,000 left. So where would you rather have your money sitting where you can borrow from it for banking purposes? Would you rather have it in a life insurance policy? Would you rather just have it in a savings account earning hardly nothing at the bank? Makes all the sense in the world to use your infinite banking policy as your bank. Here's another very important feature for this ultimate safety of your money. The insurance company is not leveraged. Whereas banks just put banks leveraged. Highly leveraged. What does that mean? And why is that important to consider? Well, by law, if a bank has $10 million, they can lend out $9 million and leave $1 million in the bank. That's why you hear this phrase, the run on the bank. And see, if everybody went to the bank, everybody that had a bank account with that bank went to the bank and said, give me your money, they wouldn't be able to do it because they don't have the money. It's lent out. That's how banks make money. That is the reason why banks came into existence in the first place, is a way of making money. Because they saw a need that people had to lend money, even short term. And you have people with a lot of money say, look, I have the money, you don't, I'll lend it to you. You give me collateral, you pay me interest, and you can use this money for a while. And that later on turned into where you actually have checking accounts, things like that. You can study the history of, it's called fractional reserve banking. So you can do your own research on that, and maybe one day I'll make a video on it. And I recommended a great book on it in the past. But banks are highly leveraged. They have to be highly leveraged in order to make any money. So consequently, 2008 comes around. The economy goes into the toilet. The real estate market, the mortgage industry goes into meltdown. These banks have lent out tons of money out there for building projects, and no one's paying that money back. Then people come to the bank and they want to get money and things like that, and they're in a situation where we don't have the money. And they go out of business. And that's why in 2008, tens of thousands of banks all over the nation, including one of the largest, Washington Mutual, went out of business. And that's why some of these financial institutions had to be bailed out by your tax dollars, because they're highly leveraged. And they're highly leveraged even today. The mutual insurance companies aren't leveraged like that. For every dollar they take in, they gotta have in reserves money that they can pay out every single death benefit. In other words, if there was a run on the insurance company, they'd have the money to pay all the money back to you. Folks, I've said this many times to people. The safest place you can warehouse your wealth, as I have referred to it in the past, the safest place is either in a whole life insurance policy, especially when it's structured the right way, or a fixed annuity. And a fixed annuity is considered an insurance product, and it's with the same companies. Whole life policy, fixed index, not a variable, a fixed index. You'll never worry about your money. Not going to lose it. You can't lose it. There's guarantees all over the place. The companies aren't highly leveraged like the banks are. Your money is safe. That's a very, very important concept to remember, folks. Very important. Because there's people out there with $100,000, $200,000, $300,000 sitting in a bank someplace doing nothing, waiting for the day when an opportunity will come around that they can use that money. Whereas that most of that money, the bulk of that money, should be in a properly structured whole life policy with a mutual insurance company. That's where it should be sitting, earning interest, creating a tax-free legacy, available to them when they need either to pull the money out or borrow from it. Much better to borrow from it. And if something happens to the person prematurely, there's a huge death benefit that's tax-free that goes to the heirs. It makes all the sense in the world. So insurance companies, my friends, the big insurance companies like the Guardians and I use Mass Mutual and Guardian, Lafayette Life, these other Penn Mutual, they've been around since the 1800s. They're not going out of business. I mean, in the Great Depression, when all the banks were failing back in the 30s, insurance companies just kept cranking out money. They kept paying their policyholders. They kept paying out on the annuity interest. They kept paying out on the interest and dividends for their whole life policy. They just kept paying out year after year and never skipped a beat. Banks failed everywhere. Stock market failed. All these financial institutions failed. My question to you is, where do you want to have the bulk of your money? Okay? Even your 401k money. I've said it before, you should fund, and I wish I'd have known this when I was a lot younger, but you should fund a whole life policy designed as an infinite banking policy before you should ever fund your 401k. That's the truth. So that kind of gives you a little bit of a rundown on how it works. Now, when you borrow money from an insurance policy, it's a lot more flexible, as you saw earlier, than with the bank, because the bank is going to want you to have a regular schedule of how you're going to pay that thing back. And they'll tell you, this is the way you're going to do it. You're going to pay this certain amount of money every month for the next 2 years if you've taken out a 2-year CD. And at the end of 2 years, you need to pay it back. And if you don't pay it back, they're going to take your money out of the bank. Okay? With an insurance company, they don't care if you ever pay it back or not. Now, if you've read Nelson Nash's book and you want long-term viability of your financial future, you want to be an honest banker, you want to pay back the loan. Be an honest banker. Okay? But they don't really care how you pay it back. If you don't pay anything on it for the first year, they're going to want you to pay at least interest on it. And if you don't pay the interest, they will take interest out of your cash value. I mean, it's a business. They need to make their profit, and you get part of the profit. And you need to treat your infinite banking policy as a real bank. This is my business. I have established a bank here. I have funded that bank, and now that bank is available to me. And so you pay it back, but you can pay it back any way you want. You can pay it back once a year, once a month, once a quarter, however way you want to pay it back. You can pay you can pay on it for the first 6 months and not pay anything on it for the next 6 months. Doesn't make any difference. The bank says, hey, you want $10,000? Here's your $10,000. You've got $12,000 or $15,000 or $11,000 or $20,000 in the bank. And in the cash value, you want to borrow $10,000? Go ahead and borrow it. Here it is. How do you want me to pay it back? We don't care. That's your choice. You pay it back how you want it. Now, my advice is to put yourself on a regular schedule of paying that thing back. Create your own amortization schedule. Pay it back. Say, I'm going to pay this back in 2 years. Pay it back in 2 years. Okay? Meanwhile, if something happens and you can't pay it for a few months, it's no big deal. The insurance company is going to take your money. The insurance company is going to continue to pay nice interest and dividends on your cash value all along. So it's far, far superior to do banking and borrowing from your assets if that money is in a life insurance policy, an infinite banking policy, as opposed to putting it anywhere else. Well, might say, Victor, I would just pay cash for everything. Well, you could. I'm not going to fault you for wanting to pay cash for everything, but it's not the smartest thing to do. If you just kind of look at it try to look at it in an objective way. Well, I'm going to pay cash for that car. Okay, fine, go for it. How much is a car? Well, the car is going to cost me $20,000. Wow, you've done a very good job saving $20,000. Well, I sold this thing over here, and I sold a property. I'm going to buy me a car with it. You could do that. You take $20,000, buy a car, as opposed to if you bought a new car for $20,000 and you drive it off the lot and now it's worth $15,000. Well, that's a really good use of cash, isn't it? You've just taken $20,000 cold, hard cash and put it into something that loses its value as soon as it drives off the lot. Why not have that $20,000 in your policy, borrow from it, pay it back, and when you pay back the policy, you have more than $20,000 because your cash value is growing. We like to call that recapturing your interest because you're paying interest, but your cash value is growing. So, if it takes you 5 years to pay it back, your cash value has grown quite nicely during that 5 years. So now you have even more money to borrow from. You see, I was having this conversation with a person the other day. Having an infinite banking policy and using it the right way makes you so incredibly responsible with your financial future. Let me explain very quickly as I end this video. In order to be successful with infinite banking, you must be a person that's inclined to save money. You must be a person that's inclined to be smart. Smart. Not dumb, but smart with your financial future. Let me explain. If you have $20,000 in a cash value policy, you could, if you wanted to, take the whole $20,000 and buy that car. You could pay cash for it. You've saved the money. The money has grown, so you got two things. You didn't save the whole 20. You put in some, it's grown to 20. And you could say, you know what, I'm just going to take that money out and I'm going to pay now. That would be dumb because you would lose your policy. That's all the money you had in it. You would say, take all the money out, cancel the policy. I'm going to buy this car with it. That'd be stupid too. But you say, I've got the money. I could pay cash. I've got the assets, the hard assets to pay cash for that automobile. But that wouldn't be smart. That wouldn't be smart. I'm going to borrow against it. Buy the car cash. The insurance company is going to lend me $20,000. I'm going to go down there. I'm going to write a check for $20,000 for that car. I own that car. I have the title in my hand. No one can take that car from me. Now I'm going to take cash that I earn every month and I'm going to pay back that note. Pay back however you want, but I'm going to pay back that note within a certain period of time. Now the car is going down, down, down in value, but my cash value over here is going up, up, up. When I pay that car back, pay that loan back to the insurance company, what do I have? Okay, I have an automobile that's worth a certain amount of money. Maybe now it's only worth $11,000. But it's a piece of property that I have that's worth $11,000. Over here, I may now have $25,000 in cash value. You see what I'm saying, folks? I've got my car and I've got $25,000 cash over here in cash value. Now you keep the car for a while, you trade it in, you borrow some more money, you buy the car cash, you get the title, you pay back the insurance company with interest, your cash value continues to grow, the loan to the insurance company is paid, you've got the title to that second car that you bought, that you replace the other one with, and now your cash value, I don't know, it could be $30,000. You still may be contributing to it. You may have stopped contributing to it by then. You may have decided, I'm just going to contribute till I got $20,000 in cash in there, and I'm not going to contribute to it anymore. That's fine. The policy will continue to go. And you'll have a perpetual bank there that grows every single year. But what are you doing? In essence, you're still paying cash for everything. I've got the money. I'm paying back my insurance company. My cash value is growing. 20 years later, 20 or 30 years later, you've bought who knows how many automobiles. And after it's all said and done, you're sitting on 6 figures of cash value in your policy. Or you could pay cash for everything, and 30 years later, you've bought all these cars and you got 0 cash to show for it. Nothing. By that time, the cash value of your policy, because we're using paid up additions, goes up. The death benefit goes up and up and up every single year. And guess what? That death benefit doesn't cost you anything to maintain after that first year. Nothing. You got all this extra death benefit that's generating no cost out of the insurance because it's paid up, but it generates lots of cash, interest and dividends. Your cash value grows and grows and grows and grows. Your death benefit grows and grows and grows and grows. And you can go your whole life and you can borrow for anything: college, vacations, fix the car, remodel a house, start a business, buy cars. I don't care. It's infinite. That's why they call it an infinite bank. Whatever your mind can conceive. But you're always paying it back. Paying it back. You get to your, man, if someone in their 25 years old starts this, by the time they get 65, they've purchased and financed a whole lifetime of things. 40 years of things they have done, and at the end of it, they've got all of this money sitting in their life insurance policy, and now when they get ready to retire, it's going to pay them a nice tax-free income for life. That, my friends, is the power and the wisdom of using an infinite banking policy, of getting an infinite banking insurance policy and using it to finance the rest of your life. You're responsible. You're putting money every month in and month out, building up that bank, building up your cash reserves, building up that financial security. At some point, you're going to say, I got enough in there. I've got enough in there. All my cash value is up to $40,000. I'm good with that. It's going to take care of most of my lending needs, and it'll continue to grow. You can stop it at that point. You can let it go paid up. Reduce paid up. No more. Think about it. You go reduce paid up. No more cost associated with that policy. You understand that you now have an insurance policy with a nice death benefit, and the death benefit goes up every single year, and there is 0 cost associated with it. It just produces pure interest and dividends, cash value. No cost. It's a beautiful thing. Okay, well, this is Victor with Victor for Advice. I hope this video has been helpful. I hope it gets you excited. And if you want to talk to me about seeing how this can possibly work in your life, well, I'll be happy to talk to you. All right? Take care and God bless.